Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. It's the summer of syndication. We've been talking for the last several weeks with folks that raise capital to do bigger deals. And we're going to wrap up the series talking about the legal considerations for syndicated investments, whether you're an active or passive investor. And we've got a great guest today on the Real Estate Guys radio program. As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Joining me, as usual, in the co-host seat, it's our financial strategist, Russell Gray.
Hey, Robert.
We are wrapping up our series today we're calling the Summer of Syndication. If you've been with us the last several weeks, we've been meeting folks that have made the decision to not just invest in real estate in their own account, but to raise capital to do bigger deals. And that's near and dear to our heart. We've been in this space a long, long time. We think there's great opportunity, but there's also, with great opportunity comes great responsibility. There's a lot you need to know. And today we're going to focus on kind of the legal side of how you get into this part of the business.
Yeah, I think a lot of people in the audience listening to this right now have read the book Rich Dad, Poor Dad, and perhaps are familiar with his cash flow quadrant, the concept of the E and S, which is the employee and the self-employed person, and then the B and I being the business owner and the investor. And those are 2 different sides. And he often talks about it from the tax perspective because it's just 2 different mentalities also. So when you move over from being a self-employed person to being a business owner, there's a transformation you go through. When you move over from being an investor and turning your investment into a business, there's a transition you go through. And so a lot of folks out there are probably active real estate investors. I mean, we're the Real Estate Guys, we're an investment talk show. So they're out there doing business under the Department of Real Estate, whatever their state is, right? They're buying and selling real estate, they're individual transactions where you're taking title to a piece of property. And that is all in one area of law.
Yeah.
When you cross over and you're starting to do syndications and you're forming legal entities and selling membership shares in that, it's like selling stock. Now you're in a different area of law, and that's the securities law. And so when you decide to move from being a small business owner to a big business owner, you have to change. You have to learn. You have different advisors. You learn more about leadership and management. You're getting things done through teams. When you decide to move from being a solo investor and you start to move into where you're going to be raising other people's money, there you have new advisors, you have new things you need to think about. So we couldn't, in good faith, talk all about syndication without talking about the responsibilities that you have and understanding that you've moved from the real estate area of law. Not that it goes away. It's not a moving away from. You're adding to it the responsibility to understand the securities law side of it. And that can be a little bit complex and intimidating unless you understand the basic concepts and then have good counsel.
And today's show isn't designed to scare you away from either investing in a syndication or becoming a real estate syndicator. Quite the opposite. But you do have to go in eyes open and understand you have a higher responsibility in lots of different ways. Legal, certainly one of them, when it comes to raising capital. It's serious stuff. You can make serious money at it, and you can have a serious impact on your investors' future fortune. When we come back, we'll talk to our good friend and attorney, Mauricio Rauld. He's a securities attorney. He's going to bring us up to speed on not only what you need to think about in this arena, but also some of the new changes coming down the pike when it comes to this area of law. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide. You're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've ever dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2024 Goals Retreat, January 12th to 14th in Dallas, Texas. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at goalsretreat.com. Get your life back on track, physically, spiritually, and financially. Attend the 2024 Goals Retreat on the second weekend of the new year. Visit goalsretreat.com to learn more and get on the advance notice list. This is no dress rehearsal. Live the life you were meant to. Visit goalsretreat.com or call 888-489-7723 extension 18. That's goalsretreat.com. The Real Estate Guys are throwing a party and you're invited. Join us at the New Orleans Investment Conference, November 1st through 4th. Now in its 49th year, it's the world's longest-running investment conference and features some of the biggest names in economics and investing, including James Rickards, George Gammon, Danielle DiMartino Booth, Rick Rule, and Peter Schiff. The Real Estate Guys are speaking in multiple sessions, attending lots of others, and we're hosting an invitation-only party one of the evenings for our friends and listeners, including some VIPs for you to mingle with. So make your plans to join the Real Estate Guys at the New Orleans Investment Conference. With all that's going on in the world, no serious investor can afford to miss it. Send an email to neworleans@realestateguysradio.com and we'll get you all the details. That's neworleans@realestateguysradio.com. And we'll see you there.
Hey, it's Ken McElroy. I listen to the Real Estate Guys, and so should you.
Welcome back to the Real Estate Guys radio program. Now in our 27th year of broadcast, we're talking today about syndication and specifically the legal side of raising capital. To help us do that, welcome back to the Real Estate Guys radio program, attorney Mauricio Rauld. Hey, man.
Always good to be here. Thanks for having me.
Well, you've been on the show a lot over these many, many years, and as an attorney, you certainly have a good working knowledge of real estate law and of asset protection and all those things, but your primary responsibility these days is helping syndicators put together the legal paperwork. So I think big picture is this line we talk about that you cross from investing in your own account, qualifying for your own loans. It's you if it goes well, it's you if it goes poorly. When you cross over the line and accept investors' money, the whole world changes.
It does, because even though it doesn't make a ton of sense, you actually start being in the business of selling securities, which I know doesn't make sense. And I get that question all the time. I'm like, Mauricio, why is the SEC, the Securities and Exchange Commission, involved? Why are they in my face? I'm just buying a piece of property. It's a single family, or it's me and my buddies. Like, why do I have to worry about all this stuff? And the reality is that under the law, under the regulations, the definition of a security is really, really broad. And the structure that comes up really doesn't matter. At the end of the day is, are you taking money from passive investors where the returns are generated by your efforts? If you're in that business, you're in the business of selling securities, which means you've got to comply with a whole world of not only federal securities laws, but also state securities laws.
Well, because it depends on where your investors are as well as where the property is.
Yes, 100%. It's the SEC governs the offer and sales of securities, but the states do have some say. And so if you are selling or maybe even making an offer to an individual in a particular state, the state regulators do care and want to make sure that you're following both federal and state securities laws.
So when you think about a security, we think about, big companies, rooms full of lawyers, reams of documents. But in reality, that's more along the line of a registered security. So if I'm named the big company and I can buy shares of their publicly traded stock, well, that is definitely a security. Because if I buy a share of a company, I'm relying not on myself, I'm relying on the company, its management, its products, its team to produce the return, whether that's going to be in dividends or just growth of the stock. But with what we're talking about, maybe a small apartment building where you get 10 folks that each put in $100,000 and you have $1 million that you need for your down payment and your CapEx and so forth, technically still a security, but you're not necessarily registering that security.
you're definitely not registering the security, but think about it. Typically, those deals, the investor is investing in an entity, and usually it's a limited liability company, but the investor owns 2.5% or 7% of an entity.
Yeah.
That is really the security that you're investing in. But even if you eliminate the entity, again, the structure itself doesn't matter. Even if you set it up as a tenants in common, or maybe you decided to just take money in the form of notes, the structure itself doesn't matter. It really comes down to whether you are taking passive investors. And to your point, Robert, there really are two separate markets. There's the public markets, which you talked about. I think most people are aware of the S&P and NASDAQ and Dow Jones. But then there's the private markets, right? And which is more of the mom and pops and any other market that they don't register. But it got a little bit hazy a little while ago because they allowed people to advertise in the private market. So usually you think of the private market, you think, I'm only having it with people in my network, people I know. But back in 2013, which I guess it's been 10 years now, they expanded that and allowed advertising. So now it gets a little bit more confusing because now when you're advertising, that sounds like it's a public offering, but it's not. It's actually technically still a private market.
So in those kinds of deals, in fact, we call the paperwork a private placement memorandum or PPM, and it is private. It's not public, but you still have the two obligations. One is to make sure you're operating legally above the board, which we're going to assume anyone who's serious about this business is going to do. And then two, you have to make sure that you find an exemption to registration. So can you talk about that part of it? That's a big core part of this.
Yeah, I always try to make it as simple as possible because securities laws can obviously get they are very complicated and there's a lot of them. But at your level, meaning the syndicators level or even the investor level, I always like to say there's really three things, right? So you either have to register that syndication, which is going public. So we don't want to do that. We don't want to put our syndication on the Dow Jones or S&P or whatever, right?
Maybe not to start.
Not to start, right? So if you're not going to register, you have to find an exemption to registration, right? That's where I live, in the exemption world. So my job is to listen to your deal, understand what you're trying to accomplish, and then select one of the numerous exemptions that are out there so I don't have to go register the particular security with the SEC. And then to finish it off, I always joke that the third option is it's illegal, right? So you want to register your security, find an exemption, or it's illegal.
Or break the law.
And
we don't recommend that.
We don't recommend that. And my world is just trying to find out what exemption do we rely on? And fortunately, there's a couple that are pretty popular and the vast majority of people use.
And I think, the first part of this is just to recognize this additional diligence and requirement as soon as you think, well, I'd like to do a deal with my buddies. And many syndications are that. My uncle's going to put in $100,000 and my sister's going to put, $150,000 in and we're going to go do this deal. Well, even though that might be family involved, that is a security. And it's either, in that case, probably not a registered security, an exemption to security law. But just because you're finding an exemption doesn't mean there aren't compliance issues. So let's speak to that part. How do I make sure that I am doing it and correct and dotting all the I's and crossing all the T's?
Yeah, that's an excellent point. Just because you're not registering doesn't mean I don't have to do anything. And somehow I found some way around or some carve out.
It's a loophole.
A loophole. No, not at all. You're just relying on a particular exemption. And whatever exemption you end up relying on, you have a very robust amount of regulation that you still have to comply with. Yeah. So it's still extremely complicated, but at least we start narrowing down the things we are obligated to do depending on that particular exemption. But they all are premised on this idea of disclosure, right? It's all about disclose, because what you as a syndicator want is to make sure that your investor, when they look at your deal, that they're looking at it with eyes wide open, that they have all the important, what we call material facts, all the information they are required to make an intelligent decision as to whether this is an investment that's good for them. And on your part, obviously, you want to be able to provide that information. So your job is to make sure you're disclosing all of the information about the deal, about the structure, about yourself, your past. And if that happens, then we're going to be in compliance on whatever exemption we have, so long as we obviously comply with all the other items.
We've got a lot of listeners that invest in real estate, own real estate, have been doing it for a while, and they're thinking, well, gosh, I could do more if I had more money. Maybe soliciting, for my deal would make sense. But they usually focus on, having met hundreds and hundreds of these people, the deal. Here's the market, and the market's great. Here's this fabulous property that I got. Here's this amazing property manager that we have. And here's where there's a need in the marketplace and we can fill it. And you need all of that if you're going to attract investors. But the big part of the legal documents the way I see it, is you have to have that sobering reality that things can and do go wrong in real estate or whatever you're syndicating. It's not just real estate, right? Most major motion pictures are syndicated. A bunch of people come together. There's a legal structure, and they're going to share in the profits if there are any, and they're going to share in the loss if there isn't any profits. But the concept of I want to put together the risk assessment and the factors. This is a big part of it. If you think about any real estate deal, we're usually looking at it as all the things that can go well. But as the attorney, you also have to make sure you're looking at all the things that could go wrong.
Yeah, and look, the example or the parallel that I like to draw is whenever you go have some sort of surgery, no matter how minor it is, I tend to have oral surgery all the time. I have terrible teeth. And so anytime I go get my wisdom teeth taken out, or some other procedure that requires going under anesthesia and having a procedure, they send that little yellow sheet, right? That medical consent form where they can say, hey, look, even though we're taking out your wisdom teeth, you might get a little bleeding, you might get an infection, you might die from the wisdom teeth, right? All of those risks are disclosed in that medical consent form, and then you review them, you're good with them, you sign off on that form, the doctor signs off on that form, then you're off to surgery. Same thing with the syndication with the investing world. You disclose all the facts, you have discussions with the investors, they review them. Some of those may be very, very unlikely to happen, but at least they're disclosed. So again, the investor goes in with eyes wide open, they review the disclosure documents, sign off on it, you sign off on them, and then you've got your agreement.
You know, we love real estate, and we love all the reasons that real estate makes sense, but here's what we know. Not every deal turns out the way you expect. We often talk about, the baseball player that gets 4 hits out of 10 is in the Hall of Fame. That's an amazing track record to get 4 out of 10, meaning that baseball player 6 times out of 10 goes right back to the bench. And yet here, it's one of the best players there is. In real estate, people expect it always to go well, and it's not going to. Probably not in your private investments, and certainly not when it comes to these kinds of things. Sometimes it goes better. Sometimes it takes longer. Sometimes it costs more. And since we don't know, we just have to go in eyes open, as you say, but make sure the investor understands this. And this brings up another important topic, and that is suitability. If I'm thinking about raising capital, having other people I know put money in the deal, I have to go above and beyond to make sure that they, 1, understand the risks, and that's what we're talking about here, but 2, that it doesn't take an inordinate amount of their liquidity or their net worth.
Yeah, so typically when you have investors, you are having conversations with them, right? You don't just meet somebody off the street and I want to give you $100,000 and take their investment. You are required by the law to have what they like to call interactions with your investors, whether they're in-person meetings, whether they're phone calls, Zooms, it really doesn't matter. But your job as a syndicator is to really speak with your investor to find out whether they have that knowledge and expertise in, financial and business matters where they can really determine the risks and the merits of your particular investment. That's really what you're trying to, at its core, what you're trying to accomplish when you're talking to the investors. Are they sophisticated enough? Is this a suitable investment for them? And then they're obviously asking you questions about, well, what's your investment thesis? What are you buying? How does it work? But the SEC really wants you guys to foster that relationship between syndicator and investor so you can figure out if this investment is suitable and whether the investor is sophisticated. And to your point, Robert, you would never want to take a significant amount of the investor's net worth or liquidity, right? There is no law or anything that requires you to take a certain amount, but generally speaking, I think it's probably best practice not to take any more than maybe 15 or 20% of somebody's net worth or liquidity, investable assets anyway. So if somebody comes to you and they want to give you all of their life savings to invest in your deal, that's probably not something that you should take, and it's something that you should probably discuss with your investor to maybe go a little bit lower on this one and diversify some of the risk.
Well, and I think the other important part is just the legal side of having a relationship is these interactions. Totally understand that, but from a practical business side, you need to do that anyway. I'm not just going to meet somebody at a real estate event and instantly say, "Hey, here's the wiring instructions." No, I want to slowly develop a relationship and find out, would this deal make sense for them? And secondly, are they the kind of person I want in my deal? And part of that is, personality and expectation and history and all that. But part of it's also based on what this person wants to accomplish in their life. Does my deal fit? If I'm buying a big apartment building and our plan is to keep it for 10 years and just have it throw off cash, and they're about tax benefits, Well, we'd have to explore that. Okay, what are the tax benefits of investing in this type of a deal, and how is that going to work with the way they earn their income? These are the conversations you have. And normally people, just like, anything else with a relationship, you don't jump into business right away. You're kind of feeling the other person out. And I think this is an important part of the business from a practical point of view. It just also dovetails into the legal side and this disclosure issue. And so let's talk about the practical part of that, because if you look at a private placement memorandum document, there's a bunch of bold type and here's all the things that can go wrong. And you often counsel people that that's not the first document you give somebody.
Yeah, no, absolutely. I mean, if somebody is looking to invest in your deal, sending them a 200-page legal document is probably not a good business practice. So generally speaking, the sponsor will put together what we call marketing materials, but it's really sort of a business plan or a prospectus, which it's really a marketing document. We do review it for legal, make sure you're not going a little crazy with some of the representations. But this is where you get the pretty pictures of the property and what the business plan is and all that stuff. And those are a little bit shorter. Those might be anywhere from 5 to 10 to 20 pages. So usually that's the first document that you would send out. If you don't even send a shorter document, sometimes called a one sheet or one pager, which is really the first level. And sometimes these days people are doing that in an email. So they'll just send an email with some really broad stroke information about the deal, because, investors may not have the money and wherewithal to invest. They may not like the asset class. There's a bazillion reasons why they wouldn't want to do it. But those that do raise their hands from that one email or one pager, that's when you would probably send them this business plan or business prospectus as the next level. And then once they review that, you're probably getting into conversations with them to discuss that. And then when they really, really like the deal and it's like, yeah, I'm serious about investing now, that's when you would say, okay, well, before I take your money, let me give you this document, these disclosure documents. As you mentioned, they're typically called private placement memorandums, where you incorporate all of the risks involved in the deal. And then once they review that, they execute those documents, wire you the money. That's when the transaction gets consummated.
Now, that process that we've just explained it parallels the sales process. You reach out to somebody who's on your list, somebody you met, someone you know, someone you have a relationship with, and you say, hey, we're doing this deal, and here's kind of the big overview. The one sheet. It's this market, here's the minimum investment, here's the type of performance we're expecting, a range of what the returns might be. Maybe it has, particular tax benefits. Maybe there's another reason people want to be involved with it, a personal use component or something like that. They see that, they're like, okay, well, I like what I'm seeing. Could you send me more? And then you send them more information. So it's kind of back and forth. And at any point, the person says, I don't think it's for me. Hey, no harm, no foul. We want to be in the business of syndicators of getting the right people in, not getting just any people in. But as they are more and more interested, that's the time to explain, here's what could go wrong. Like when I look at a passive deal, I love the sunshine, I love the unicorns, but I want to know all the ways I can lose my money. What could go wrong in this deal? And if the syndicator doesn't have a good answer for that, then I'm not interested.
Yeah, and keep in mind, again, the private placement memorandum, the PPM, is a pretty depressing document, right? It's all the risks, the ways your investment goes wrong. So you really want to make sure that your prospect is really liking the deal and they're really convinced of the deal, because people sometimes say, well, just we need to get them the PPM. Nobody's going to invest in the deal because of the PPM. They're going to invest in the deal based on the conversations you have, your reputation, the business plan, the prospectus. When they see the PPM, you've got to make sure that you've convinced them enough that this is a good investment for them, or they really are convinced that this is for them. Because reading the PPM, if anything, will probably bring them down a couple of notches. You just want to make sure they still are across the line when they review that scary document.
Yeah.
Don't get me wrong. The PPM is a critical document in this process. It's something that every investor should read, and you as a syndicator 100% should be reading to make sure everything is in there. And so it's a very important document that everybody should be reading.
I'm glad you brought that up, because it's a big document. A client comes in, they ask you to prepare this. You're going to ask them a ton of questions. You're going to get your mind around the deal. As the attorney, you're not vetting the deal. You're not doing the due diligence in the deal, but you're making sure that it's legally compliant. And then you ship it off to them, and they can't wait to send it out to their people. And what they really need to do as a syndicator is read the entire thing. One, so they truly have an understanding of the risks, because I know you guys put stuff in there to protect them that they may or may not understand. But two, When you're sitting across the table from an investor and they're serious, they've gotten to the point where they're looking at the risk factors in the private placement memorandum, and they're going to ask you a question about, page 72, paragraph 3. If you've not read it, how does that look? Like, you don't need to have a complete legal understanding of it, but you at least need to be able to have a conversation. Now, I also know that many times it makes sense for them to take it to their legal counsel. So let's talk about that. What happens when an investor, passive investor, wants to invest and your law firm or another law firm has prepared the documents? Is that enough, or would you suggest that they have an attorney review this?
I would highly recommend, as a passive investor, to take that PPM and have your attorney review it. The ounce of prevention is worth whatever the saying is, right? I would recommend every single passive investor to do that. Not too many do. I'll be honest, because there's a cost involved and there's speed involved. But there's no reason. I love it, by the way, when I get comments back from another attorney, because it also keeps me on my toes, makes me make sure that I'm articulating the risks adequately. But it rarely happens. But I would, if you're listening to this and you're a passive investor, I would 100% recommend that you run this through your attorney to make sure that you understand all of the risks and the merits of the deal.
Well, this lets us transition to something I wanted to cover. Is this series, the Summer of Syndication, is not just to show people that they might be interested in becoming syndicators. It's also for passive investors to be able to figure out, what is it that I look for? So let's take that angle. Imagine someone who wants to deploy some capital to real estate. They don't have the time or the inclination to go to markets and meet brokers and go to classes and spend time learning. They just, they got busy lives. They want to put money to work. And they are going to be looking at a deal like this. What is it they have to make sure that they're seeing?
Well, first and foremost, they have to be doing their due diligence on the sponsor themselves. That's probably the number one thing. There's not a lot you need to do as a passive investor. And in fact, once you wire your money, you're not doing anything at that point. You're truly passive. But your main responsibility is to vet the sponsor.
Yeah.
Make sure they have a track record, make sure they know what they're doing, make sure they have expertise, not only as a syndicator in general, but that particular asset class. Because if they've been syndicating mobile home parks all these years, and now they have an office building they want to syndicate, well, do they have the expertise in that particular asset class? Do they have an expertise in that particular marketplace? Maybe they've been investing in the Dallas-Fort Worth area and they're masters at that, but now this is a new market. They're in Ohio or something. And so do they have somebody boots on the ground that knows that market, that has all the relationships with the team, with the property managers and the lenders? All those things. Get into conversations with other investors that have already invested in those deals with them, which I know sometimes can be challenging, because if you just take a referral from the sponsor, it's probably going to be one of their best investors. But if you can find an investor who's invested there before, talk to them. How did that experience go? What was the level of communication during the investment? All these things to me are really the most important thing you're looking at prior to making an investment. And then, of course, you're looking at the deal. But the deal should also match your personal investment philosophy, right? You want to make sure that your philosophy is aligned with the sponsor's philosophy. And that's, again, is part of these conversations you're having at a larger level, even before you look at the deal. Because to your point, I think you mentioned it earlier, if I'm a cash flow investor and I'm retired and I need the cash flow, and this is a development deal and it's not going to spit off any cash for the next 2.5 years, it's probably not a fit. And so understanding what, make sure that you're aligned. And then, of course, you want to look at the numbers and you want to look at what they're projecting that's going to be returned, and whether you like the deal and the marketplace and everything like that. But to me, it starts with vetting the sponsor.
So suitability is something we think about as a syndicator, but really a passive investor needs to think about, am I suitable for this investment? And that brings us up to one of the criteria as a syndicator, is whether or not you focus on a class of investors that we call accredited. And let's talk about that. And then I know there's some changes that you want to bring up, but what do we mean when we say accredited investor?
Yeah, that's a moving target as we record this podcast. But generally speaking, an individual is accredited if they have $1 million in net worth, excluding their primary residence, or has earned $200,000 the last 2 years with a reasonable expectation of earning that this year. And if they're combining income with their spouse, that goes up to $300,000. Recently, or maybe a couple years ago now, they also added a couple of licenses that you can have that will qualify you as accredited regardless of your net worth or income. So if you're an investment advisor, you have a Series 7, Series 65, Series 82, you're in good standing with your state, you're also going to qualify as an accredited investor. So that's where we stand today officially on the books.
And the whole premise is that an accredited investor is someone that has the financial wherewithal to make this kind of an investment decision. So most investors are not accredited, right? The majority of people in the world don't meet the requirements you just mentioned. And so some syndicators are focusing on only people that are. But what if I'm interested in syndicating with people that aren't accredited? That is possible.
Yes, if I want to syndicate with somebody who's not accredited, you're just limited to a couple of exemptions that are out there. One of them being the most popular one, right? So there are exemptions. Not to get technical, but if you're doing a 506B, B as in boy, that does allow you to allow a limited number of non-accredited investors, as long as they're sophisticated, as long as you've vetted them and they understand the risks and merits of an investment. You can take up to 35 non-accrediteds, which is why it's such a popular exemption, because especially new syndicators tend to have their initial investors be family members and friends, and inevitably somebody's non-accredited. So that's a very popular exemption because of that fact, because they do allow you to take some non-accredited investors.
And the reason it's important, you mentioned earlier this change of being able to advertise. Only if you take all accredited investors can you advertise. If you're not taking accredited investors and you're allowing up to 35 non-accrediteds, you can't publicly go out and talk about your syndication, which makes it a little more cumbersome to figure out how am I going to raise the money.
Yeah, I mean, there's a much less accredited investors, obviously, as you mentioned, than non-accredited investors. And, even when you do allow non-accredited, again, you're limited to 35. So if you have, not enough accredited investors in your deal, because you typically have non-accrediteds and accrediteds, then you might be running up into that 35 limitations much quicker. So even if you're doing non-accredited, you typically have accredited investors in your deal, which is why you want to keep track of who's accredited, who's not. And these days, keep track of what actually constitutes an accredited investor, because that definition changes, it seems like, every year.
Our guest today is Mauricio Rauld. He's an attorney that helps people not only put together syndications, but review syndication documents if you're a passive investor. We'll talk more when we come back, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
For thousands of years of human history, silver has been recognized as money. Then in 1965, the United States took silver out of the financial system. But did silver stop being money? Smart investors don't think so. And ever since, when there are concerns about the quality of the currency, alert investors seek shelter in silver and gold. As the size and frequency of major financial crises grow, silver is attracting a lot of attention. To help better understand the what, why, and how of silver, watch the free 9-part series, Making Sense of Silver. Everything you always wanted to know about silver but didn't know to ask. Featuring 30-year precious metals veteran Dana Samuelson. Send your email requests to silverseries@realestateguysradio.com. Whether you own silver now or you're wondering if it's too late, email silverseries@realestateguysradio.com.
Self-storage is an asset class that has stood the test of time. Going into the Great Recession of 2008, self-storage had the least negative impact of any of its commercial real estate peers, and it had explosive growth coming out of that time during the recovery. Fast forward to 2020, and you'll see that same pattern during some of the worst part of the pandemic. Hi, my name is Dave Zook, founder and CEO of The Real Asset Investor. Our operating partners are some of the best in the business, and we've had great success over the last decade buying mom-and-pop operated self-storage facilities and taking them to the next level by forcing value through increasing the square footage, adding climate-controlled units, bringing in our professional management teams, and turning the project into an institutional target. We have self-storage investment opportunities available for accredited investors who are interested in investing in this space for cash flow, tax impact, and huge equity appreciation. Reach out to us today at self-storage@realestateguysradio.com.
Hi, this is Steve Forbes. You're listening to The Real Estate Guys. Have fun. You'll learn something.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you want more clarity in your life, if you want to focus forward, if you want bigger, better, and brighter opportunity in the new year, then come on out to Create Your Future. The 2024 Goals Retreat happens the second weekend of the new year in Dallas, Texas. You get all the details at goalsretreat.com. That's goalsretreat.com. We're wrapping up the summer of syndication, and we're talking to attorney Mauricio Rauld. We'll get back to that interview right after we play Real Estate Trivia, your chance to win a prize by knowing today's Real Estate Trivia question. When you hear it and think you know the answer, send your best guess to trivia@realestateguysradio.com. That's trivia@realestateguysradio.com. You want to send us your name, the answer to the question, and your physical mailing address, because the first person to get it right gets an awesome book called How to Use Limited Liability Companies and Limited Partnerships by our friend and Mauricio's friend, Garrett Sutton. That can be yours if you know today's real estate trivia question. Last week we had Michael Mead and Randy and Jana Hubbs on the program. We asked this: where is the most expensive home in the world? Well, it's in London, England. The most expensive home in the world is Buckingham Palace. The royal residence is valued at around $5 billion, which is 5 times the value of the second most expensive home in the world, Antilla, which is located in Mumbai, India, and is a mere $1 billion valuation. I myself laid eyes on Buckingham Palace for the first time earlier this year. Here's our real estate trivia question for this week. Which U.S. state has the most attorneys? Yeah, of all the states in the United States, which one is number one in terms of population of attorneys? And that's per capita. So not just the number of attorneys, but the most attorneys per capita. If you think you know, you want to guess, or you're practicing law there, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Send us your name, your best guess, and your physical mailing address. The first person with the right answer gets an awesome book by attorney Garrett Sutton, How to Use Limited Liability Companies and Limited Partnerships. That's today's real estate trivia question. It's the summer of syndication, and we're talking about the legal side of protecting investors and yourself. If you're the syndicator, we have attorney Mauricio Rauld with us. Now, we were talking about accreditation before the break, the idea that some investors are considered more worthy of investments because of their financial status. The accreditation rules that you shared with us actually come from decades ago. So let's talk briefly about the fact that both passive investors and syndicators should understand there may be some change on the way.
Yeah, ever since they passed the new law that allowed syndicators to advertise their deal and limit their deal to accredited investors, the amount of companies that have gone public since 2013 has been declining steadily. And the SEC has been trying to figure out whether it's due to too much regulation at the public market level or too little regulation at the private market level. And so one of the things that has been going on recently is they're really addressing the private markets, where we involve private placements. And they've decided that on the one hand, I believe they're going to want to make the accreditation standard much harder than it is today. Right now, as we mentioned before, it's $1 million in net worth is your requirement. There's been some rumblings that they may increase that as much as 10 times, $10 million, which seems like a lot. But they're scheduled to get together doing their spring agenda here at the end of the year, and we fully expect that the limits to that accreditation standard is going to increase substantially. To your point, these laws were passed in 1982, where $1 million used to be worth something. Just adjusted for inflation, that's about $3 million today. So I anticipate that number is going to go up to $3 million, therefore making a lot of investors who are currently accredited non-accredited. However, to counter that issue, there has been already some rules passed by the SEC that have allowed some form of a licensing arrangement or certification process where you can become an accredited investor irregardless of your net worth or income requirement. They've already done those with those securities licenses that we discussed earlier, but they've also proposed having some kind of a test, the SEC has, where somebody would go take an exam and presumably pass it, and then they would become accredited. We just haven't had any details on that, and it's been sitting on the shelf now for a couple of years. And what's recently happened is that Congress has kind of gotten involved now, and they've introduced a couple of bills to basically codify this idea of having the opportunity to become accredited via some examination. And so there's 2 bills, the Accredited Investor Definition Act and the Equal Opportunity for All Investors Act of 2023. They both passed the House of Representatives with an overwhelming majority. I mean, it wasn't even close. There's so much support behind this. And it's currently sitting in the Senate, where we expect that to pass the Senate here sometime this year. And that will then codify this idea of having an exam that somebody's going to be able to take to become an accredited investor. Something pretty substantial, something similar to the Series 7 or Series 65 that people take today, where they're going to ask you and you're going to have to learn and know how to read a financial statement, to understand what the securities laws are, what the exemptions are, what the disclosure requirements are, all of these informations that really you should know as a passive investor. You're going to have the option to take that exam and become certified as an accredited investor that way, versus having the income or net worth, because there's been a lot of debate over the years as to whether really income and net worth and your financial wherewithal is really an adequate or even fair criteria as to whether you should be able to invest in some of these deals. There are some amazing opportunities in the private placement world. Why should that be only set aside for a few elite investors who can afford it, right? So anyway, I think that's going to be something that by the end of the year will be crystallized, and you'll have, I keep talking about this dual path to accreditation, right? On the one hand, you can be an accredited investor by financial means only, but that's going to be harder. $3 million, $5 million, $2 million, whatever the number ends up being. And then the alternative path is you'll be able to go take an exam if you so choose and become an accredited investor that way.
The only thing constant is change, so appreciate that on the update. But it's been the accreditation definition for so long, it's not surprising that they're looking at changing it just because of inflation, if no other reason. So, Mauricio, let's take folks through what the process looks like if they want to engage a securities attorney and actually go and raise money. You have two things to think about. You got to find a deal, meaning, a market, and you've got a team. And so you've got the real estate part of it, or if it's a business, but, or a real estate show. So I've identified a property. This is a property that would be great as a syndication. I want you to cover what I need to do from the legal point of view. So kind of what comes first in the context of, in a competitive market, if I'm in contract on a deal, I have this time fuse I have to close. And you mentioned earlier the race for the documents. And I know people come to you all the time saying, all right, here's everything. I need it right away. So let's just help them to understand what the process looks like. I found a great deal. I want to raise money. I call your office. Now what?
Yeah. So first of all, we're obviously big into relationships like you guys are. And so I try and speak with every potential client early on in the process, even before they have a deal, just educating them a little bit, what their options are from the exemption standpoint, understanding how they plan on raising, where are their investors going to come from? Are they going to advertise? Is it their existing investor base? So there's already a relationship that we like to establish early on so that by the time they actually get an LOI accepted, right? Once they now have a deal, they reach out excited. It's like, Mauricio, I finally got, I've been sending LOIs out for the last 6 months. One got accepted. Can we hop on a phone call? And that's when we have sort of our official first phone call. That's usually when we get engaged, usually either at the LOI or once they sign the contract, they'll engage us. And then we start the process of, again, getting to know them and their deal. So we typically want to look at their business plan, review their business plan in detail. We spend a lot of time on the business plan, actually going through it line by line, and we'll have 1,000 questions and 1,000 comments. We'll hop on a call with the investors to, again, pull the information from the investors because, I have a good idea about the deal based on the business plan they provide. And also we send out a questionnaire. But the purpose of these phone calls now, these meetings with the client, is to pull the information because they don't know what's relevant or what they should be disclosing. So that's our job, is to pull that information from them. From there, we're creating all the entities that need to be created, which don't take a ton of time. They take sometimes a week, depending on where the property is located, what entities we need to set up. But then we start going to work on drafting these offering documents, right? The private placement memorandum, operating agreement for the entities, subscription agreements, questionnaires, all that stuff. And that, we have a pretty good turnaround speed. So we usually get those done. If somebody really needs it and wants it done, we can get them done as quickly as a week.
Wow.
Usually takes us 10 days to 2 weeks, but it's not uncommon for us to get clients who just kind of waited a little too long and they really are up against the clock. And so we try and accommodate that and give them sort of that fast turnaround speed. And then, of course, once that draft of the offering documents is done, we send those to the client, have the client review to what we talked earlier, make sure they're reading everything and make sure that, we're on the same page with everything. We usually get another call to sort of review the revisions and the comments. And so we kind of go back and forth with several drafts of the PPM. Once that PPM is done and finalized, by then all the entities have been set up, bank accounts have been set up. So now the client's ready to send those documents to whoever they think it's appropriate. Clients sometimes do a webinar, depending on the size of the deal. Sometimes they'll do it's become more and more popular these days to do a sort of a presentation, but sometimes it's just one-on-one phone calls. Sometimes you have 9 or 10 investors. And then they're off to the races. raising their capital. And then the last thing we end up doing is we've got an obligation to file a form with the SEC called a Form D, which gets filed 14 days, 1/4, after the first sale. So we prepare that documentation and we stay in touch with the client, so making sure they're telling us when investors are coming in. And so we file the Form D with the SEC. We then file the Form D with every state that we're required to file. And then hopefully we pop the champagne once they close the raise and the deal.
All right. Well, I think the important part there to understand, and I know people have a misunderstanding about this, is the law firms aren't going to create the executive summary normally. This business plan they submit to you. Now, you review it so you can call out of it the things that you need to put into the rest of the document, but also you will shine a light on some of the things that maybe their language isn't correct or they're making a guarantee, and you help them refine that. So hopefully they engage you prior to having that document out. I know when we've done this over the years, you look at it from the protective side and say, hey, you might change this, you might use a different picture, let's use a range of potential return, not an exact amount. So you do have some feedback, and you're going to have to account for some time there. And especially when it's a competitive environment, knowing you're going to syndicate a deal, you better plan for a little longer close of escrow. Maybe the seller wants to close in 30 days. Maybe you would normally be able to close in 30 days, but because of all these additional steps, just plan a little extra time.
Yeah, I mean, we I think spend a little bit more time on the business plan than most. I think a lot of people just take the business plan for granted. We actually do a deep dive on it. And one of the things I like to do a deep dive actually is on sort of their pro formas. Because the pro forma tells me a story, and a lot of times I can look at the numbers and I see something that's a little bit off, and that I'm like, hey, why did this number go from here to here? Maybe it's an insurance, or maybe it's whatever it is, and then they'll say, oh, it's because we're doing this, or we couldn't do this, or we couldn't do that. So that then gives me more insight as to what else needs to be included in the documentation. So we do a deep dive, and I think a lot of clients sometimes get a little surprised with that because they're not used to having somebody really drill down on their business plan. But to us, it's the only way I know how to get all the information about the deal and about the sponsor is by asking them questions and reviewing their business plan with them and drawing that information from them.
We've heard in the last few weeks from lots of successful syndicators, many of your clients, in fact, who have figured out how to do this. But you have a really interesting perspective because you've worked with tons of different people, lots of volume, little volume, start and stop, and so forth. What are the common mistakes you see syndicators make that you might be able to help folks understand so that they're more set up for success?
I think let's go with maybe the beginner mistakes. If you're just getting into this business, one of the biggest mistakes is going to be not understanding that you're actually selling securities, that you're actually needing to do a syndication. I get this comment all the time where it's like, oh, it's a small deal, I don't think it's worth doing a syndication with it. Or to your point earlier, oh, it's only my mom and my dad and my family members, right? Even though there's no exemption to that. Or my favorite, oh, we're going to do this one as a joint venture. Right. And so they try and come up with creative structuring. But again, anytime you're taking money from passive investors where the returns are generated by your IFAs, you're in the business of selling securities, and you are generally required to give that full set of disclosure documents, as we like to call the private placement memorandum.
All right. So I think the key is to practice safe syndication. To that extent, you've actually got a pretty cool resource. Tell us about that.
Yeah, I actually wrote an ebook called The 5 Things Every Syndicator Must Know to Stay Out of Jail, and we do talk about some of the mistakes in that book. But I've recently updated it, so I've got a sort of a second edition because I wrote that a couple years ago, and I'm seeing more and more of newer mistakes that syndicators make that are becoming more and more prevalent, especially in the space of funds. A lot of investors have turned to doing blind funds or fund of funds, and that's become a really big part of our practice. And there's a ton of mistakes being done in that area, so I wanted to articulate those in the second edition.
If you'd like to get a copy of that awesome report, all you have to do is send an email to jail@realestateguysradio.com. And to be clear, it's to stay out of jail. Jail@realestateguysradio.com. You'll get Mauricio's report, which will also give you his contact information if you want to learn more. Mauricio, it's been great as always. Thanks for the update, and we'll see you at the Secrets of Successful Syndication in October.
We'll see you there.
You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
If you've been listening to the Real Estate Guys for a while, then you've heard about the legendary Investor Summit. Simply put, it's the highest level event we do, and the content, faculty, and attendees are amazing. If you're serious about taking your real estate investing to the next level, consider joining us. You'll spend more than a week with like-minded investors, world-class educators, and real-world professionals, and you'll have a blast. It all takes place next summer, so to get the details before they're released to the general public, send an email to summit@realestateguysradio.com with the subject Summit 2024. We'll add you to the advance notice list, and you'll be invited to spend a fun-filled week learning and networking with more than 25 class sessions and breakouts, plus small format roundtable discussions, great dinner conversations, and a ton of fun. Send an email to summit@realestateguysradio.com with the subject Summit 2024 and be among the first to get the details to join the Real Estate Guys and an all-star faculty on the 22nd Annual Investor Summit.
Hi, this is Doug Casey, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into this show, our final episode of the summer of syndication. Not that we're taking our foot off the gas, but there's been a lot to learn these weeks, and I think a fitting way to end the series was learning about the legal side from Mauricio.
Yeah, well, I mean, we do want to kind of end on a high note. Not that Mauricio's not a high note, but we affectionately call him the wet blanket because attorneys just check you in reality. So you have to ask yourself, why would anybody bother with all this? Right? And you have to really think about this for a minute. The reason you do it is so that you can go bigger faster. If you're going along and you see good deals and you see more good deals than you have money, or you have a desire to turn your investing into a full-time business, but you don't have the capital, syndication's that path. Most people who are investors work a day job they may or may not like. They earn their money. They use their credit. They go buy real estate. They build their portfolio over time with the goal of someday being a passive income earner out of the rat race, living off their portfolio. And so when do you build that portfolio? Well, in your spare time. So now you got two jobs. You got your day job and you got your investing job. By combining the two, by becoming a syndicator, you make your business the business of investing and you access other people's capital. So that's the reason why you would want to do it. And like any business, no matter what business you chose to start, you're going to have to learn some things. You're going to have to learn the rules and regulations. You're going to take some financial risk. You're going to make some capital investments. You're going to have to learn how to build and manage a team. Learn how to sell and manage goodwill and manage your customers and solve problems, all of those things, right? That's just any business you want to go in. So if you're going to go into a business, go into a business where you have a chance to make a lot of money doing something you already enjoy. I'm guessing people who are listening to this show are already real estate investors. They like it. On the passive side, as an investor, you might think, well, gosh, this is a lot of hassle. I mean, I got to vet the sponsor and da-da-da. Candidly, you should be doing all that anyway. There's this false sense of security we have when we go into Wall Street. We go into Wall Street and go, oh, it's a publicly registered security. There is zero training required for an investor to go in and do day trading with stock options, and they can open up a brokerage account and they can buy securities in companies like Enron, that was a complete sham, false accounting, being audited by a major accounting firm most people today probably have never heard of, but back in the day, Arthur Andersen was a very respected firm. So it isn't that you go into the public market and, oh, it's safer because it's publicly registered. Conversely, when you go into the private market, it isn't necessarily safer just because you're doing business with friends. On both sides of the equation, you have the responsibility to understand what you're investing in. Does the investment thesis make sense? Does the team managing the investment know what they're doing, have a track record? Are you taking the appropriate amount of risk for what you're doing? And is the investment objective of the investment match up with the investment objective that you have for your portfolio? I used to sell securities. I had a securities license, and I would go out and talk with people, and I would hand them the prospectus.
To read carefully before investing.
And they had to sign a document saying that they read it. I can tell you they never read it. I'm guessing most people right now that have securities in their 401k or in their brokerage account have never read those prospectuses, even though they've all signed documents saying they have. So it isn't a matter of public or private being safer, or they're both the same. So the advantages of being private are those deals tend to be a little bit flatter. You don't have the big buildings in Wall Street, the big, Wall Street commissions, and you don't have the regulatory expenses, just a lot flatter. There's usually the person you're dealing with, their team, and the deal. Right, it's very flat. So more of the profit can get back to you. The other thing is they tend to be a lot more transparent. Not necessarily, because public is forced to make disclosures, but if you have a good syndicator and they are explaining to you how they're going to communicate to you and they do it, it can be a lot more transparent, and you actually have a relationship with the principals, or should. So you should have a little bit greater comfort of who you're doing business with. And a lot of times the kind of deals you're investing in, you can relate to. Like if I go invest in a biotech company or a high-tech company, I don't understand anything about bioscience or technology. I have no idea. Is this science good? Is it bad? Who are the I don't understand all that. Right? If I go down and look at an apartment building, like, okay, I kind of get that. And I can go to the apartment building next door and pretend to be a tenant and find out what they charge for rent and see if what we're charging is competitive. I can do that, right? I understand the model. I understand what it takes to manage it successfully. I can see who the competitors are. I understand right? I'm not saying you have to do all that homework, but I can. It's just easier to understand. And the big one for me is privacy. I tend to really value privacy. And when you go invest in a brokerage account, it's indexed to your social security number. You're in these databases. If you have a high profile profession that, like a doctor, where you could be sued and people can find where your assets are, it's just nicer to be able to be involved in private placements that are more private. They're not in a database. People can't run around and find what you have unless they have the ability to access your tax returns, or they bring you in some form of a deposition where you're compelled to disclose. Other than that, your investments are private. And there are a lot of other investments, but I wanted to kind of end on that so people are like, oh my God, why would I ever do this? It just sounds like brain damage. It isn't. People can make a lot of money on the active syndication side, building a big successful business that serves people on Main Street, and the investors can have a higher ROI, better transparency, more relationship, and some real privacy. I hope people are excited about syndication after this series and will want to come out to the Secrets of Successful Syndication and learn more, meet people who are doing it. And they're doing all kinds of different deals too. So it's not just real estate, but real estate, we think, obviously is our favorite asset class and the foundation of a great real asset portfolio.
Big thanks to Mauricio Rauld for sharing his time and talent with us today. If you'd like to get a copy of his report, then all you have to do is send an email to jail@realestateguysradio.com. That's jail@realestateguysradio.com. If you want to meet Mauricio in person, coming out to the Secrets of Successful Syndication. We've learned a lot in the last few weeks on the show. We'll learn a ton more at our 2-day event. Happens in Dallas, Texas, the first weekend of October. Get all the details on the website at realestateguysradio.com under events, where you'll also see the other places the Real Estate Guys will be hanging out in the coming weeks and months. Big thanks to all the syndicators that shared the incredible lessons and details with us over the last several weeks. We'll start a different topic next week. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.